Conventional loans can be one of the best mortgage options available, but they can also be one of the most confusing. A lot of buyers hear conventional loan and immediately think they need perfect credit, 20% down, and no debt. And that is not true. But on the other side, conventional financing is not a free-for-all either. So there are still rules, and if you do not understand those rules before you start shopping, you can end up frustrated, disappointed, or looking at homes that do not actually fit your approval. So in this video, I want to break down conventional loan requirements in 2026 in plain English. We're going to talk about credit scores, down payment options, income and job history. We'll talk about debt to income ratios, mortgage insurance, loan limits, and the things buyers usually do not hear about until they are already in the middle of the process. Make sure you stay until the end because there was a change that started in late 2025 involving Fannie Mae and credit scores. It sounds really exciting online, but I want to explain what it actually means so you do not get misled by the headlines. So first, let's talk about what a conventional loan actually is. A conventional loan is simply a mortgage that is not backed by the government. So it's different from FHA, VA, or USDA financing. Most conventional loans follow guidelines from Fannie Mae and Freddie Mac. Now, does that part really matter to you as a buyer? Not necessarily. What matters is understanding how conventional loans work and when they make sense. Conventional financing tends to reward stronger borrowers. So if you have higher credit, lower debt, stable income, and more money down, conventional can sometimes be one of the best loan options available. But here's the good news. You do not need perfect credit, you do not need 20% down, and you do not need to be debt-free to qualify. You just need to understand what lenders are looking for. So let's walk through what I call the main pillars of conventional loan approval. We have income and employment, credit, down payment and assets, and debt to income ratio, and property type and loan limits. Let's start with income and employment, because this is one of the questions I get all the time. Buyers ask, how long do I need to be at my job? In general, lenders like to see about 2 years of stable income and employment, but that does not mean you cannot change jobs. Changing jobs is usually okay if you're staying in the same line of work. If you're in sales and move to another sales role, that's usually easier to explain. If you're a teacher and you move to another teaching job, that makes sense. If you're an electrician and stay in that field, that usually works. Where it gets trickier is when you make a major change. So for example, if you've been a W-2 employee your whole career, and then last month you become self-employed, that can be a challenge. Self-employed income usually needs more history. Most of the time, lenders want to see a 2-year history of self-employment before they can count that income reliably. And the reason is simple. The lenders care about consistency. They want to know that your income is stable and documentable. There's no maximum income for conventional loans, and there's no one set minimum income either. You can make $50,000 a year or $500,000 a year, and what matters is whether the income supports the payments and whether the lender can document it. If your income is trending up gradually, that's usually okay. But if your income is all over the place, that is where underwriting may start asking more questions. Now, let's talk about credit scores. The classic rule most people hear is that conventional loans require a 620 minimum credit score. But the real world is a little more complicated. Even if guidelines allow a 620, many lenders have overlays. What is an overlay? An overlay is basically an extra rule a lender adds on top of the standard guideline. So one lender may say 620 is acceptable, another lender may say they want 640 or higher. And even if you technically qualify with a lower score, your terms may not be as great. And this is why I always tell buyers that qualifying is not the only goal. You also want to qualify well. A higher credit score can mean a better interest rate, lower mortgage insurance, and a lower monthly payment. So this is important to understand. If your credit score is barely above the minimum, it may still be worth improving your credit before buying. Now here's the Fannie Mae change I mentioned earlier in late 2025. Fannie Mae made a change where some loan files may no longer have a strict minimum third-party credit score requirement. And yes, you're going to see headlines online saying things like, you don't need a credit score for a conventional loan anymore. But please understand what that actually means. It does not mean no credit, no problem, here are your keys. It means the automated underwriting system may look at the full risk profile of the borrower instead of only using a hard credit score cutoff in certain situations. You still need to look strong overall. Stable income, manageable debt, assets, a good payment history, and a strong overall file. So yes, it may help some buyers, but it does not mean conventional loans suddenly became easy for everyone. So I want to talk about down payment. One of the biggest myths is that you need 20% down for a conventional loan. You do not. For a primary residence, conventional loans can go as low as 3% down, and you can also put 5%, 10%, or 20%, or even more if you want to. Here is the honest truth about the 3% down. Just because conventional allows it does not mean conventional is always the cheapest monthly payment. If your credit score is not strong, conventional PMI can get expensive. And in some cases, FHA may actually have a better monthly payment. That is why your lender should not just push you into one loan program. They should be showing you options side by side. Conventional, FHA, VA if you're eligible, USDA if it applies, and you should be able to compare the interest rate, monthly payment, mortgage insurance, cash to close, and long-term cost. That is how you make a smart decision. Now let's talk about mortgage insurance. If you put less than 20% down on a conventional loan, you will usually have private mortgage insurance, also called PMI. PMI is not there to protect you, it protects the lender if you default on the loan. And if you're putting less than 20% down, PMI is not optional. The cost of PMI depends on several things, including your credit score, down payment, loan amount, and overall risk profile. The lower your credit score, the more expensive PMI might be. The higher your credit score, the more affordable it can be. One big advantage conventional has over FHA is that PMI can eventually be removed. Once you have enough equity in the property, often around 20%, you may be able to request that PMI be removed. Sometimes it happens automatically. Sometimes you need to ask. Sometimes an appraisal may be required. But the point is, conventional PMI does not have to stay forever, and that can be a major long-term benefit. Now, let's talk about debt to income ratio, because this is one of the most misunderstood parts of getting approved. Your debt to income ratio is your monthly debt divided by your gross monthly income. Gross income means before taxes, insurance, 401k, and deductions. So lenders are not looking at your take-home pay. They're looking at your income before deductions. For debt, lenders are usually looking at what shows on your credit report. Car payments, student loans, credit cards, personal loans, installment loans. They are not counting grocery gas, your Amazon habit, or childcare unless it's part of a specific underwriting requirement. That is why I always remind buyers what a lender says you qualify for and what you personally feel comfortable spending may be two different things. There are two ratios people talk about. There's a front-end ratio and a back-end ratio. Your front-end ratio is your housing payment only. That includes principal, interest, taxes, insurance, and HOA dues if there are any. Your back-end ratio includes your housing payment plus your other monthly debts. Let's use an example. Say your total housing payment is $3,500 per month, and say your gross monthly income is $10,000. Your front-end ratio would be 35%. Now, let's say you also have a $500 car payment, $200 in student loans, and $300 in another installment loan. That's another $1,000 in monthly debt. Now your total monthly debt is $4,500. Divide that by your $10,000 gross monthly income, and your back-end ratio is 45%. In many conventional scenarios, around 45% on the back end is pretty common. With strong compensating factors, some approvals can go higher. But just because you can qualify higher does not automatically mean you should. Compensating factors are things that make your file stronger. Higher credit, more money down, cash reserves, stable job history, strong income. The stronger the file, the more flexibility underwriting may have. But again, the lenders tell you what you can qualify for. You decide what you can comfortably afford. This is so important. I don't want buyers becoming house poor just because the lender technically approved them. Now let's talk about loan limits. Conforming loan limits matter because conventional loans have a maximum loan amount before you move into jumbo financing. In 2026, the baseline conforming loan limit for one unit property is $832,750. That is higher than the 2025 baseline loan limit, which was $806,500. So the increase is about $26,250. For some buyers, that may not matter, but in higher cost areas, that can make a real difference. High cost areas have higher limits. For example, in some high cost counties, the one unit limit can go up to $1.2 million. The exact number is $1,249,125. Now I want to clear up a myth. When loan limits increase, people sometimes say it makes housing less affordable. But raising loan limits does not make underwriting easier. It simply helps the conforming loan program keep pace with real home prices, so buyers are not forced into jumbo loans just because the market moved. Now, let's go back to the Fannie Mae credit score change. Fannie Mae's automated underwriting system called Desktop Underwriter changed how it evaluates certain files. Instead of always using a hard minimum score cutoff in every situation, it can look at a broader risk assessment. That may include the overall borrower profile and other payment behavior. But again, this does not mean anybody can get approved without credit. The best pricing still goes to buyers with strong credit, lower debt, more money down, more reserves, and stable income. So don't let internet headlines make you think the rules disappeared. They did not. Now, if you're thinking about getting approved, let's talk about what you actually need. First, understand the difference between pre-qualification and pre-approval. A pre-qualification is usually just a conversation. You tell someone what you make, what you owe, and what you think you have for a down payment. They give you an estimate. A pre-approval is different. That is when a lender reviews your documentation, runs credit, verifies income, and gives you a much clearer answer. If you're shopping for homes and writing offers, you want a real pre-approval, not just a pre-qualification. The lender will usually ask for pay stubs, W-2s, bank statements, identification, and sometimes tax returns, especially if you're self-employed. The reason you do this up front is simple. You do not want to find out that there's a problem after you fall in love with the house. Now let's compare conventional to FHA for just a minute. Conventional can be better long-term because there's no upfront mortgage insurance premium like FHA, and PMI can eventually be removed. So strong borrowers often receive better pricing with conventional financing, but FHA can still be a better option if your credit score is lower, your debt-to-income ratio is higher, or conventional PMI is making your payment too expensive. Again, the best answer is not always one program. The best answer is comparing options side by side. Now, here are a few common conventional loan questions. Can you use conventional financing for a primary home, second home, or investment property? Yes, conventional loans can be used for all three, but the requirements get stricter as you move away from the primary residence. Second homes and investment properties usually require larger down payments and stronger qualifications. Can you use conventional financing more than once? Yes. Conventional loans are not a one-time program. You can use them multiple times as long as you qualify. Can you use gift funds for a down payment? In many cases, yes. Gift funds from family members are often allowed, but they need to be documented correctly. So talk to your lender before moving money around. And finally, closing costs. Closing costs vary by state, lender, and loan program, but you should expect to have money beyond your down payment unless you negotiate seller credits or lender credits. This is another reason getting pre-approved early matters. You need to know the full cash to close number, not just the down payment. The biggest mistake I see buyers make is waiting too long to talk to a lender because they think they're not ready yet. But if you're thinking about buying in 2026, starting early does not mean you have to buy tomorrow. It means you give yourself time to improve credit, time to save, time to lower debt, time to understand your options, and time to make a smart plan. So here's the takeaway. Conventional loans can be a fantastic option, especially for buyers with stronger credit, stable income, manageable debt, and some money saved. But conventional is not automatically better for everyone. You need to compare the full picture, the payment, the PMI, the cash to close, the long-term cost, and your personal comfort level. If this video helped you, leave a comment and tell me what feels like the hardest part of qualifying right now. Is it the credit, the down payment, the monthly payment, or just understanding where to start? If you are in the market to buy or sell, click the link below. I respond within 24 hours. I can help on the real estate side or the lending side. I would love to connect you to a real estate agent that does business just like me, or on the loan side, we can help in almost all 50 states. Thank you so much for being here, and I hope to see you in the next video.